going to look at two things today. First of all, the fear levels at the market. Have we reached the bottom yet? And when are we expected to U-turn based on historical data? And then in the second part, we're going to look at three stocks, look at the current valuation, and as they've been hit hard by the current fears in the market. And we're going to play out a few scenarios to see if it drops further, how are your expected returns to go up? And if it goes up by a U-turn, how are your expected returns to be affected in the future? So let's get straight into it. But if you haven't yet subscribed, please subscribe to the channel before moving on here, right? So let's go. First of all, we'll look at the Fear and Greed Index. Hasn't really changed over the past week. It was at extreme fear level already. I think it was at that 19. So we're just hovering around that really like extreme fear level in the market at the moment. So which hasn't really changed, as you know, none of the situations that caused this fear, which is basically interest rates, trade war, none of those situations have changed or have progressed in a meaningful way. So there's not been any more clarity for investors. So that's why extreme fear is still here, because there's the uncertainty of how high are the rates going to be and how basically high the pressure is going to be on the valuations of high growth companies, but also the war in terms of what are the potential outcomes, for how long is it going to drag on. No one really knows, right? So we do see Fear and Greed Index for stocks still at extreme fear level. And the similar pictures when we look at the Fear and Greed Index for cryptocurrencies, we do have an extreme fear level here as well, which is kind of interesting because we were expecting, when the drawdown happened, when the crash or correction started to begin, we were expecting that Bitcoin and other cryptocurrencies might potentially serve as a inflation hedge, or like as a hedge against those drawdowns in the stock market. But what we've seen is that it's just been treated as any other risk asset. It's been holding up a bit better than sort of growth stocks. I think growth stocks like something like a PayPal, SOFI, those have been hit much harder, and the volatility of those is much higher than for Bitcoin, which is quite unusual. But still, we haven't seen it perfectly working as a hedge. So yeah, extreme fear level here as well. And then going to the next slide. So this is basically an overview of how wars or how war shock events affect the market in terms of the S&P index. What is the drawdown? What is the expected bottom in terms of days, and how many calendar days it takes to recover? So we're actually ahead. I looked it up. So on the 24th of February, the war started. So we're pretty much 21 days in. And if we see here, the average of, you know, the bottom for it to play out is actually 22 days. So it seems like, based on historical data, we're pretty much at a bottom. And I think if you look at the stock market, what you've seen is that when we had the interest news, first of all, the high growth money losing stocks fell. Then we had medium growth sort of things like Facebook, PayPal, but then also some other medium growth like Twilio and Uber falling. And now we've seen starting like Apple and all those mega caps to start fall as well. So it seems like really the market is drawing now money from all sides. And based on this data, you know, when talking about the war at least, we can see that we might have reached a bottom here if we base it on historical data. And then days to recovery, it takes almost double or more than double than it takes for it to bottom, for it to recover again. But we do have to have in mind that we do have other important things happening, such as the FOMC, so the Fed meeting, which happens later tonight, basically, where decisions are going to be made about the interest rates. And we do expect quite a lot of increases this year. So I think the market already priced in anything from 6 to 8 interest rate increases at an increased rate of 0.25%. So it's basically, if the Fed comes out today and says, we're increasing the rate by 25 basis points, so 0.25%, I think that's in line with expectation of the market. I would actually not even be surprised if we see an uptick in the market if this was the case. If there's anything like, much higher than that, so if they say anything north of 0.5, 0.75 or so on, I think that might cause a shock in the market, because then they expect that to happen each time of those 5 to 6 increases. They are basically pulling that increase forward and being more aggressive in that. So yeah, I would expect a further drawdown if that would to happen. But if we see a 0.25 or even a no increase at all, I think that would have a really positive effect on the market, as they would then say, okay, at least from that perspective, we don't get hit straight away and valuations don't get dragged down even further, because a lot of that is already priced in. That's what we have to really consider here, right? I mean, over the past few months, we've seen drawdowns in some of the stocks 60, 70, 80%. I made a video yesterday if you want to check it out. All these stocks, like 20, 30 stocks, down more than 60 or 70%. So, I mean, how much lower is it gonna be? I mean, how many more people do we need to, selling out of those stocks? So I think that even the slight surprise in either the war, the wars kind of things that happen there, or the Fed will cause a huge uptick in the market. So yeah, but let's move on to 3 stocks that I want to talk about today. So Voyager Digital didn't really move much on the OTC market. It did move on the Toronto market, Toronto Exchange. And then HIMS and HERS, we had an 11% upward move, which seems like crazy, but yesterday we just had about the same drawdown percentage. So we actually had much more yesterday. Was at a low of at 390. I can't believe it. And then going to SOFI, we have a 3.4% uptick today to $8.20, which is still so far below from all-time highs. We had around $25 at the peak, which happened last November actually, and a few times actually it peaked around at that level. But yeah, now still well below 10, well below the IPO price. So what I was trying to do here today is, what I wanted to show you is basically I've listed down here the current valuation metrics, so the price, market cap in $1 billion, and the price to sales ratio. And on the right side, this is basically the scenario that can play out if we get a surprise. For instance, tomorrow, if the Fed is surprising us with lower than expected rate increases, we might see a 10% uptick in the market, and especially in those stocks where there's small market cap already fallen 70 to 80% from their highs. A 10% uptick is not even very unrealistic for those types of stocks, as we've seen it today actually playing out. So I wanted to show you that what does a 10% increase even mean, and I mean what in terms of that column here, what is the potential upside for those types of stocks based on the price to sales ratio target that I've given them, and how does the upside change if we change the percentage increase or decrease. So if we're giving them a 10% increase, each one of them, we are looking at still very low stock prices as such. That doesn't really mean much as well. And I've said basically, if nothing changes, we are looking at currently, so at the current price to sales ratios of those stocks, where I've given HIMS a 5, I've given Voyager Digital a 7 because they have just insane revenue growth, and I've given SOFI a 10 just because it's a much more popular stock. There's much more, there is a premium that can be expected as it's more mainstream than HIMS and Voyager, as they are just still gaining attention in the markets. SOFI is really out there, so a lot of people know SOFI, a lot of big investors are already in there, so I've given them a premium over the other two. So we still have massive upsides already. So if you buy in those prices right now, I see an upside in HIMS of at least 133%, Voyager 360% upside, so massive upside potential there if the market really acknowledges the huge potential for this company. And in SOFI, I've given also 110% upside at those levels. So what would happen if we if you were a bit scared right now, you're not buying in, and you might wait a little bit, and then we get suddenly a 20% uptick in the market? I just wanted to demonstrate how low those valuations have become, that even a 20% upside move, which for any stock would be like, oh, you missed the chance to buy the dip, right? But not in this type of market, because we have seen HIMS, Voyager, SOFI going down over 70%. So even a 20% upside move from those low prices still gives you around 100% upside on HIMS potential. Voyager 280%, and SOFI still a 75% upside. So it has to move like massively for it to change. So a 50% upside move from those low prices right now still gives Voyager a very nice 200% upside potential in my point of view, and around 50% for HIMS and SOFI, if you can't be that exact. But even after a 50% increase, and imagine that, right? You bought the dip at 430, you get a 50% increase of your initial investment already is good. And even if you were to buy in at those levels afterwards, you still have really nice upwards potential here. And obviously that works the same way, even better. So if we do get another surprise, another thing that, another uncertainty, another shock to the market at those levels, we do see upside obviously just increasing from those zones, because we don't have any negative news for any of those companies. They all released their Q4 earnings. They all have smashed earning expectations. They have grown revenue massively. They are having strong gross margin. They are looking at years of future growth, years of future revenue growth. So none of them really has anything negative to say about them at the moment. And things like HIMS, we just see positive news one after the other, one collaboration after the other coming out. So why are the stocks down so much? So it's purely the macro environment that we're in, the fear that we have seen right now, the extreme fear levels. And I think this is just a time where you can make use of it. You analyze this, you look at those, you look at their financials, you look at the management, you look at the revenue growth perspective, you look at the TAM, the total addressable market for those areas, you look at future vision, future potential for those types of stocks in those industries, because they are all doing something disruptive. HIMS is working in the telehealth disruptive industry, trying to bring you telehealth across your phone, that you're connected with your doctor via your phone, and you get your subscriptions just purely remotely, basically. Voyager is purely in the crypto space, staking your coins, but also paying with crypto, developing a card to pay with crypto, using cryptocurrencies, and making it really accessible for a lot of people. And SOFI, obviously the new 21st century app for banking, so all-in-one solution for banking, no branches, no personal contact, all via phone. So all of them are disruptors, and all of them have huge potential side, and obviously that just increases as the stock price draws down even further. So you just have to disconnect yourself from, okay, this is the macro fear. As we can see in the graphs, we can see it quite easily that the whole market is a fear mode. Even if you see that, especially when things like Apple, Microsoft, and Google and Nvidia start to fall down massively as well and start to correct, that's when you know that we've reached top fear level. And stocks like HIMS, Voyager, and SOFI, you have to be just aware that if you invest in those types of stocks, they are high volatility, high uncertainty stocks, because they're still early in their growth phase. They have a lot of growth ahead of them, but a lot of uncertainties at the moment. So you can't just value them as easily as something like a Coca-Cola or Microsoft, where you're just so sure that all this cash is going to come in because they have already this massive business and this massive international presence. You have to expect, if you're an investor in one of those three companies that we've seen today, that your account balance is going to fluctuate on a daily basis by more than 10%. Like, you have to just be fine with that for that future huge upward potential. And this is just based on the current valuations, right? That what I've just shown you. I mean, that doesn't count in any future growth potential. So I'm just saying that if you invest in those, be aware that they are obviously a higher beta stocks. And what that means is they just fluctuate way more than the market. If you can't handle it, then you need to go with, you know, more established businesses that you can value quite easily, where the valuation is very clear to a lot of people, and hence they don't fluctuate as much, because a lot of people know how much Johnson & Johnson should trade for, and a lot of people agree to a similar price, hence the fluctuation is not that high. For something like HIMS, a lot of disagreement, right? There's a lot of people that think HIMS could be 100x, and there's a lot of people who think HIMS will be bankrupt and it's not a business model. So there's a lot of disagreements in the market, hence the higher volatility. But yeah, obviously not financial advice. You need to do your own due diligence and on those, and only if you can stomach the volatility and the fluctuation in your portfolio on a daily basis, only then you can reap those future potential profits from those types of smaller stocks and high growth potential stocks. Yeah, so this was all I had to cover today. I hope you enjoyed the video. Let me know in the comments what you're buying today, if you are happy to buy at these levels, are you still waiting, or what your plan is basically. See you next time.